Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we take an in-depth look at global debt cycles and in particular whether the economic impacts of the coronavirus will prove to be the catalyst for the popping of the current debt bubble. Building on renowned hedge fund investor Ray Dalio's work in classifying and identifying long and short-term debt cycles, we look today to fold in the current global strategic policy responses to the outbreak to help answer the question, debt deleveraging, is this the big one? I'm joined today by our Head of Investments, Damien Klassen. G'day to you, Damien.
Hi, Tim.
Wonderful. And just a quick reminder before we get started to subscribe on YouTube and to click the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. And for those listening in live, head on over to nucleuswealth.com/webinar and leave any questions in the chat box below to have them answered along the way. So let's get into it. Our agenda for today, so we're going to start by looking at bubbles, debt bubbles. We're going to start by classifying, then identifying, and also look at the conditions which they prevail. We'll then roll on to the crash, work our way through some policy responses, and then, of course, fold all this in, as we do at the end of every podcast, into the investment themes of what we do today, into the portfolios that we run at Nucleus Wealth as well. So to get us started, we'll kick off with an overview, Damien. What is a debt cycle?
Yeah, thanks, Tim. Look, so throughout this, we're leaning pretty heavily on a lot of the work that Ray Dalio has done, and he's written a number of books, and you know, you see him quite often on the whether it be podcasting or on talking about this. And I think that the key thing we want to try and get to the bottom of is, you know, are we going through one of these? Are we going to go through this a debt crisis at the moment? Is the key part. So before we start. So, you know, he's got there's quite a common chart you see up there where what happens is we go through these sort of short-term debt cycles that sort of bring the leverage up and then they fall away. And then the next peak is a little bit higher than the previous peak. And then the next trough is a little bit higher than the previous trough. And you sort of work your way up through that cycle. And that sort of lasts for, on this graph, sort of talking about a 50-year plus leveraging cycle. And we've been in this current one since about the 1960s. So we're sort of, you know, we're into 60 to 70 years into this cycle. So we're getting pretty close towards the end of it. And then you get this big event that happens at the end of the debt cycle where the leverage all of a sudden falls away. You get a whole bunch of, you get this big event where you go into big recessions or depressions, and that sort of resets your debt levels. And then you go into this reflationary period, and then finally you're back and you go away and you start your next big debt cycle. So that's sort of like the overall factor. And then the thing is with the debt, if you jump to the next slide, there's three different types of debt you can have in broad sense. You can have personal debt, so for households. You can have corporate debt and government debt. So within Australia, and each different country sort of varies as to which levels of debt are at extreme levels. In Australia, you're certainly looking at the household side is extremely high. That the graph on the right sort of shows that it spent 50, 60 years, or probably even closer to 100 years actually. Sorry. Well below 50%, and now we're sort of at over 150%. We're sort of closing in on 200% actually on some of the latest data for Australian household debt, which is basically second largest in the world. In terms of the public debt, is still quite low in the Australian side, so the government debt. And then corporate debt, we can see on the left. This is sort of a global look at corporate debt, or a US look, sorry. But you can sort of see how that's sort of showing the same cycles that I was talking about in terms of each peak is just a little bit higher than the previous one, and then you go through a recession and it falls away, but it keeps rising each time you're heading up. So I guess we've got all the ingredients there. Now it's just a question of will we go through one of these? Will we go through this big debt deleveraging cycle, or is this just going to be another short term? We'll kick the can a little bit further down the road and try and basically try again, see if we can get debt even higher before we finally have the final reckoning. I think. Sorry.
I was just going to say we've got there on the left-hand chart the the US corporate debt, and I take it the Australian corporate debt might be in a similar situation, Damien.
Similar, yeah. It's not as extreme. I think, and partly that's because Australia's a lot of Australian companies are resources, which tend to be much more lowly geared.
Okay.
So Australia doesn't look as bad on the corporate debt, but it's still certainly a lot higher than what it's been at times in the past. And so there's certainly vulnerability on that side, and particularly in the banks. That's where one of the big problems is.
Sure.
Yeah.
Okay.
Move on to this next slide. So if we have, and I guess we'll discuss the reasons behind whether we get there or not. But if you do have one of these go through one of these debt deleveraging periods, there's basically sort of 7 stages that these things will go through. At the start of it, it starts, the early part of the cycle where there's good reasons to have the debt, and there's earnings growth, and people who do borrow see a benefit in terms of the earnings they're getting. Then you gradually work your way through the actual bubble part where the debt rises, and this is sort of the graph here is showing GDP growth,
okay,
sort of, and how it sort of reaches these high levels. Then usually it is a tightening. Usually it's a monetary policy that sort of actually ends up finally killing the cycle. But sometimes they do actually sort of just collapse under their own weight, and sometimes it's external shocks that sort of that push it. And this one, is probably the mother of all external shocks in terms of the virus. And so the question for that is saying, well, if you're in a normal situation and you had this big external shock, then economies may well bounce back. And you may well see a V-shaped recovery if you haven't got this big amount of debt that's sort of sitting there, and people who are unemployed all of a sudden are having to sell their houses, or businesses shutting down and just not having so much debt that they not having customers all of a sudden means they have to go broke just because the debt costs are killing them.
Yep.
And so those types of things that then turn it into a much bigger recession and potentially depression in terms of that. So and then the next sort of stage is you go through and you the big issue though is depending really upon how your debt's denominated. So if you've got debt all in your own currency, and you've got the ability to print more of that currency, then you're much more likely to come out of this and not experience an inflation, what they call an inflationary depression. If you've got a lot of your money denominated in foreign currencies, that's where you usually get these what they call inflationary depressions, where you've got not only do you have a problem with high unemployment, but you also end up with an inflation problem as well at the same time, and they end up being much worse than people who can print.
Okay.
So let's and the final part then is this pushing on a string and normalization, where interest rates are very low, and central banks are trying to get people to do things, but it's depending upon where you sit in the cycle, you can be called what's pushing on a string, that they keep trying to get push more and get people out there spending, but people just don't want to because they're sort of being shocked, and there's psychological psychological harm that's been done. And so that sort of turns into these issues about whether we're talking about a short-term or a long-term cycle. So jump maybe 2 slides through.
Okay.
Because the big issue, so we've got to the point now where we're saying, okay, we know we've got all the conditions ready for a credit crisis or a debt crisis. We've got this huge external shock that's happened, and now we need to be working about whether what's going to happen if that does happen. And I'm basically let's go through the assumptions, assuming we do go into this. But before I do that, I just wanted to sort of look at some of the identification parts of a bubble. In terms of talking about what were the signs that you were already in a bubble, so that when this stops, you can then see what the effect is. So the first one is that usually the bubbles are what they call self-reinforcing. So what you get is lenders are out there busy trying to give as much money away to people as they can, even as people are getting more and more indebted. And it's because the rising spending from people getting out and spending that money creates rising incomes, and then that ends up more back in people's houses, and then they feel better about themselves, and so they go borrow more money, and it just keeps spiraling up.
You get this sort of wealth effect, sort of feeding in on itself.
Exactly.
Yep.
And that's what we've certainly seen in Australia. In a number of other countries, it's been similar, but not. The US has been more around the corporate side, less about the household side this time. But we certainly saw that in the US in the early 2000s, and most of Europe as well at that time. But the household side is so bad in Australia. It's in Canada and some of the European countries as well. You've seen a lot of households taking on a lot more debt. So those factors are certainly there. New financial instruments, that was another one. In the 2000s, we certainly saw a whole bunch of new financial instruments and CDOs and all these other sort of new terms that came out in terms of how can we possibly lend people more money. We've certainly seen that in Australia as well. We've had the whole Royal Commission was all about this irresponsible lending that the banks were doing, and how they were pushing credit out to people who couldn't afford it. And then Royal Commission finished, and the Treasurer and PM asked banks to get back out there and start lending again to those people, the same people that were being wrapped over the knuckles for lending to during the Royal Commission. They were saying, well, we need to get back out and lend to those people.
Yep.
We have our 95% down.
5% down. Yep.
5% down mortgages that for first home buyers that the federal government's pushing. There was a lot of interest-only lending that went on throughout the sort of 2012 to 2019 period. There were some tax changes. We brought in SMSFs, so certainly changed the rules so that self-managed super funds could borrow. So certainly in terms of new financial instruments, Australia ticks a lot of boxes on that one.
Mm-hmm.
The distribution of credit is the other important part. Is that you can get stuck on looking at the ratio of debt to income for the economy as a whole, or you can look at some of the high earners and say, okay, we've got these high earners and they can afford it, so everything should be fine. The issue is though that it really depends about how it's been distributed. So if you've ended up with payments that are, if you end up with certain sectors of society that have got payments that they're just not going to be able to make, and say it might be at the moment might be a lot of the blue collar workforce who have lost their jobs or have been unable to work throughout the crisis, and if they don't have very good, they didn't start with very good capacity to pay,
yep.
And then you've given them a much bigger shock than what you've given to say a white collar worker who's managed to work from home and keep going throughout it.
Yep.
Then that's where you get dangers as well. So just the distribution, and again, we've ticked the box on that, but more importantly, the coronavirus has probably ticked that even a little bit harder in that,
or accelerated it perhaps as well.
Yeah, in that we have seen that there's been a few different ones come out in terms of job losses according to salaries,
mm-hmm.
and it tends to be that that the highest earners have had quite minor job losses, whereas the middle class has had quite severe, and the most poorly paid workers have actually where you've seen most of the job losses.
Right.
And so it's just going that whole thing back to that inequality side of it, and saying, well, the housing market's a big market, but that doesn't take much every year because there's such a huge already installed base of say 10 million houses out there. It doesn't take, and each year you're only selling 50 to 100,000 houses. It doesn't take that much of a change to the underlying statistics just to really put a dent on that housing market and cause that just from the distribution of credit. So I've ticked those boxes. Dalio's got a bit of a checklist on the next slide of all the things that most of these, if you're looking to see if you can identify a bubble, these are the things he's sort of saying you should check off on. And so basically a price is high relative to traditional measures, and absolutely. Are they discounting future rapid price appreciation? Well, yes, because if you're an investor in one of these and your rent payments can't pay for your interest, which is the case for most sort of new purchases with reasonable leverage, then almost by definition you must be, the only reason you must be investing is because you're assuming the price is going to keep going up.
Yep.
Are they financed by high leveraged? Absolutely, tick that box as well. Buyers and companies making forward purchases. Yep, we've got quite a stream of, especially a lot of the new apartment buildings that are out there have all sort of been bought with a deposit down, sort of bought on a forward basis that you'll get the property once it's actually developed. And I think as well in some of the western suburbs of both Sydney and Melbourne, there's a fair bit of land purchases on a similar basis.
Yep.
Have new participants enter the market? Yep, we've had a lot more. We've had the self-managed super funds, and we've had a lot more foreign buyers. Broad bullish sentiment. Well, not now, I don't think, but certainly, go back 2 or 3 years, and I think you'd certainly find extremely bullish sentiment. And then there's tightening risk popping the bubble, and given we've got interest rates at zero, trying to keep everything afloat, then I'd say that's an absolute yes as well. So we've managed to tick every single box on the on that in terms of is Australia in a bubble at the moment, or in what so if there's any doubt, we've certainly managed to get all those. What's interesting on the next slide is the conditions that you're looking at and what typically tended to happen. So what you'd see there is you'd see that debt would grow faster than incomes, and that's absolutely true within Australia. The debt for the last almost at least 20 years, I think it's probably all closer to 30 years, has been growing a lot faster than incomes. And you only have to look through the Aussie banks and the sort of credit growth they've been seeing. They're used to talking about double-digit credit growth while incomes are growing at sort of 4 or 5%. And so by definition, if your debt's growing faster than your income, then you're eventually going to run out of room. Yeah. One of the things there though that doesn't tick is that the income growth high but slower than debt. So I mean, it's been slower than debt, but income growth certainly over the last 4 or 5 years has actually been quite low. So that's one of the ones that doesn't tick it, but arguably it's probably one of the worst ones to miss on anyway. You're getting all the debt growth and equity markets rallying and yield curve flattening, but you haven't got the income growth to support that debt.
Yep.
So so that sort of rolls us through. The next one I'm just talking. Yes, monetary policy helps to inflate the bubble rather than constrain it. In many of these prior sort of debt cases that we've seen, and that's absolutely been the case. And then you come back. So that sort of gets you to the bubble stage, and I think it's to us anyway. It's pretty clear that we're in a bubble, and not only are we in a bubble, but it's a very typical bubble, sort of hitting on basically every of the criteria that these prior debt crises have seen. And so then you hit this point about the tipping point. Now, often that tipping point happens to be driven from central banks just trying to slow things down a little bit. And the problem with a lot of these is that there is a time lag in that and we're still seeing that within, say, the Australian houses, that things that people started building, particularly apartments that people started building 2 years ago, are still just being completed now. So if you've got a negative view on it, there's a question: do you just abandon an apartment that's almost finished with a view that house prices are going to fall, or do you just you've already been going for 2 years or 3 years, you just push through and finalize the last part of it, and that sort of drives extra supply onto the market just at the wrong time.
Yep.
So typically you get those, and the last one there, the external shock, and as I spoke about, we've sort of really hit the mother of all external shock in terms of pretty much the whole world.
Think of a bigger one. That's incredible. Outside of war, maybe.
That's right. Yeah, that's right. And so so you hit this crash part, and then you go, okay, what's happening next? So the first thing is onto the next slide is this. What's going to how deep are you going to go? And the first issue is, how much leverage have you got, and how high are the prices? Because that sort of means that you've got less to prick the bubble and further to fall. In a normal recession, when you've still got monetary policy is still effective, you can that can sort of help fix the imbalances by making the debts for everyone easier to service.
Yep.
That's not the case now. We've shot all the monetary policy we can, and there was only a few little there's basically had a few very, very minor interest rate cuts that we could make before we've hit the zero bound. So so now it's basically coming back to this willingness to spread the pain. So our government's basically going to take on the some of the pain, or is it going to be all put back onto individuals? And if it's put back onto individuals, then you get much deeper and much more severe depressions. I think governments globally, and the Australian government in particular, has very clearly signalled that it does want to spread the pain out, and so the depth of this, the depth of a debt crisis, therefore, is going to be a lot lower if given the actions they've taken so far. But really, we're only just at the start of the really started the policy responses. So the policy responses are they're sort of broken up into two categories. First, you've got the tactical side of it, and then secondly, it moves on to the strategic side of it. So the tactical is, okay, we've just hit this crisis. What do we do? And that's on this next slide where we talk about the lower interest rates as the first one, and so tick that box. Curtailing the panic is very important. Now, we've certainly curtailed the first round of panic, and a lot of that's by guaranteeing liabilities. So some of the liabilities have been guaranteed. There's still, and we do have central banks globally sort of starting to stray into corporate debt markets. Small and medium businesses is a lot harder. So that's where it is one thing for central banks to say, yes, we're going to buy publicly listed debt, even if it is very low credit quality, and that can sort of bring a semblance of normalcy back to that the very large end of the market. But that's only sort of 30% of the market. Most of closer to 70% is the small and medium businesses who don't have listed debt. Their debt tends to be either with banks or private equity or those types of other sort of alternative asset streams. They very rarely will it ever be publicly listed, which means it's a lot harder for central banks to actually bail those out. Possibly they'll come up with a way. I can't think of what a way would be that doesn't sort of suspend capitalism, I guess, in terms of saying that nobody will be allowed to go broke, and at that point, the amount of moral hazard you're running in terms of everyone possible will be trying to phoenix small companies, and basically, yes, I'll just if I'm not allowed to go broke, then let me borrow a whole bunch more, and then I'll really go broke, and I'll I'll flip that. That'll all be paid to my brother-in-law's company, that whatever it is, and so you run into those types of hazards of people trying to game the system. If you want to try and guarantee every loan is out there. So the other types of things they'll do is providing liquidity, and central banks have certainly been in that in terms of the increasing collateral that's taken. They want to try and support the solvency of some of the banks. We saw in previous crises the types of things that have happened is they've changed some of the accountancy rules so that the banks don't have to market some of their losses, which basically lets them extend and pretend. And so that's quite a common one, actually. That's sort of happens in the Latin American debt crisis. To a certain extent, it happened in the financial crisis as well, where just in terms of how people were required to mark their losses, which basically means they can then keep going for a bit longer until they can trade out of those losses.
Yeah, right. Yep, that's interesting.
You can recapitalize and nationalize, which again you often see in these ones. One of the most important things, though, and what gives a little bit of hope behind this crisis, and I guess I'll use that hope with an asterisk on it, saying this is still looking like being a very big and extreme crisis. It's just that central banks and governments have learnt from our last dry run, and that most of the boxes that we need to tick are actually being ticked. So to date,
Yep.
Which means it's not as bad. It's not as severe as what it could have otherwise been. And that was that last one, the victim narrative. So there is the whole benefit of the virus is that when you usually have debt crises, there ends up being this part about going, something's just happened. A bunch of people have lost their jobs. It's somebody's fault. Somebody needs to pay.
The blame game. Yep.
Exactly. And that's where you get the parts where they start saying, whatever it is, here's these people who borrowed too much money, they shouldn't get bailed out. Or
Yep.
here's these people who lent too much money and they shouldn't get bailed out. And here's these bankers who made all these massive bonuses, and so that bank should go under. And so those types of ones, you need a certain part of that in terms of making sure that you don't get moral hazard for the next one. And arguably that was our problem. Part of our problem on the last one was there wasn't enough punishment meted out. But you can definitely get the other side of it where there's far too much punishment, and it's all about we need to make people pay, and that can really extend the length of these debt crises. So at the moment, what's good about this current crisis is even though these companies, well, good and bad, even though there were companies out there that were over leveraged, and individuals that were over leveraged, and basically relying on property prices going up, or relying on the fact that everything would be perfect, and things aren't perfect, and now they're going to go broke and lose their house, or lose or the business will go bankrupt, is that they don't have to blame themselves for it. They can they can point to a bigger cause and say, oh, it's not my fault. It was the virus's fault.
Yep.
And so probably good from a recovery perspective in terms of it means that it's more socially acceptable for bailouts and to support these ones. The negative side, though, is that
they're allowed to persist.
Well, yeah, you're going to end up with zombie companies is one part. These companies that just should have gone broke. And the other part is you're going to end up with a lot of people and potentially an entire political party or entire political system that doesn't acknowledge that what it was doing was unsustainable, and there was a problem with what it was doing, and that by blowing these big debt bubbles and just assuming that if we just put more debt onto the situation that somehow things would be all right, is not a sustainable way to run an economy. And so it would be good to finish this current debt cycle and get a fresh start on the next one. But it would be sad if we didn't learn anything from it. And unfortunately, I feel as if the virus will mean there'll be a lot of politicians in particular who will basically assume that everything was going fine. It was only the virus that brought things down. It wasn't that there were underlying vulnerabilities in the way we'd sort of built up this huge reliance on debt.
Sure.
So the typical ones is a slide, is another Dalio slide, just of a few of the typical things we go through, things you'd go through. And these are the tactical versions. Now, it's important. What's important to note is we're really only at the liquidity support stage. So there's been this emergency lending and liquidity. The bank liability guarantees haven't really faded off from last time, but there's probably a bit of that to come. There's been bank holidays and freezes in terms of the payment holidays. So the next step then is moving on to these. What do you do with the insolvents? And keep in mind again, we're only 2 months into this, 3 monts into this.
I was just going to say it's sort of quite early still, isn't it? It's been the market's been remarkably troubled by it, but everything else is sort of appears to be plodding along for the minute. Yeah,
and that's the part where it usually takes. I mean, it takes companies usually 90 days of not paying your bills before you're bankrupt.
Yep.
So the issue here is we're not really 90 days in, so you haven't given companies a chance to go bankrupt yet, or individuals. So people who sort of stopped paying their bills, 70 days ago are still, for all intents and purposes, not broke yet.
Yep.
Even if the practical, in practical sense they are. So, and we will see a bit of, there has been stuff put out in terms of that courts are required to be more lenient on people who are for have problems for coronavirus reasons, and tenants not being able to be kicked out of their houses for not paying their bills, which sort of so it means the actual default side of it is going to be extended as well. So if we do come out in a V-shaped recovery, which we think is highly unlikely, but maybe some of those people will be able to keep trading. The reality is most of them won't, and that will go broke. But what's happened is we've extended that period of when they will go broke for another few months. And so how that's really the next big stage is how do we address those, and is it done in an efficient manner and expedient manner? Look, you got to say, based on the reaction so far, it probably will be.
Mm-hmm.
But again, it's more about that's just taking away your tail risk. It means it doesn't turn into another 10-year depression. Maybe you've just got a couple of years of a very deep recession or mild depression in terms of what's happening. But it's again, it's not solving the problems. It's just making sure that it doesn't spiral out of control. And then the next stage you'll have to look to go through is how they're going to start disposing some of those bad debts. Whether they do, quite often what you end up with is what they call bad banks, where governments will nationalise banks and then effectively take all the bad loans, stick them all into one vehicle, and then take the good bank, the stuff that's still all right, and then put that back out and relist it or sell it back to the private sector, and then to gradually manage those bad debts off. And so effectively you're socialising the losses.
I was just going to say that. That's what it sounds like.
Yeah, absolutely. And so that if you're doing that, it spreads it out amongst everyone, and you get a more shallow recession.
Yep.
But it obviously comes with that moral hazard problem, and so we did far too much of that last time in the financial crisis, which is what sort of helps set people up for the next one, which is a lot of bankers didn't do the right thing and made a lot of money in the financial crisis and then got away with it, and so why don't you just try again?
Do it again.
Yeah. Exactly. And then at the more extreme cases, you end up with IMFs and sovereign defaults and factors like that are involved. So that's your tactical versions, which is how do I respond to problems that are going on at the immediate level.
Yep.
Then there's a strategic response to these debt crises, and so that they tend to come in 4 different parts. Austerity, which is one of the key ones we saw in Europe used a fair bit, and often gets trotted out. Money printing, debt defaults, and redistributing the wealth. So these are your sort of longer term ways of how you're going to get out of the problem. Austerity doesn't work. So it sounds really good, and it sort of runs into that problem of trying to equate a household income to the entire economy. And it's the part about it, well, if consumers aren't spending and businesses aren't spending, then the government does actually need to get out and spend in order to sort of kickstart the economy and
fill the gap.
Fill the gap, yeah. Otherwise, you get this paradox of thrift.
Yeah.
Yes. And we've seen that in Europe. Europe's just given us a great example of that in a number of those countries where it's all been about austerity, and their recovery has been how long
what recovery?
A dozen years in, and in some countries you've still got sort of double digit, or even prior to the crisis, you still had double digit unemployment. So there was the more you see about austerity and the bad signs there for Australia was discussion about when the JobKeeper is going to finish early and factors like that, and partly why that's a bad sign is even if it doesn't get extended, even if it does stay where it is, by actually raising it to everyone that, hey, I'm thinking about potentially cutting this off and stopping it, in the next month or two, all of a sudden says to people who are on it, oh really? I better start saving my money now in case it's gone.
Just jawboning a contraction.
Exactly. Yeah. Whereas the initial idea behind it was saying, hey, here's some money to keep you going, and it's going to keep you going for 6 months. By that time, you'll have a new job. And so people would go, oh, okay, fair enough. I can actually go out and spend this money, and that means more money circulating in the economy, and other people can have jobs, and you kickstart your recovery. But if everyone's sort of sitting back saving the money because they're worried about getting cut off at any minute, then that obviously is counterproductive. Money printing. So usually Australia is sitting in a good position in that Australian government debt is still pretty low relative to the world. So it's a bit easier in that the central bank can print away, and we can have basically the government taking on all this debt without too much of a worry to start with. Other countries are really going to have to start getting to that money printing stage and a bit more explicit transfers from central banks across to governments. And that's where you get these modern monetary and other. Japan's sort of basically been doing that, but it's building up this massive government debt that then the central bank's buying it all. So if you look from a top line level, the government sort of debt to GDP is well over 200%. Whereas if you sort of net out what the central bank owns, so effectively the government owns to itself, then it brings you right back down to well under 100%. So it's effectively it's a bit of a game in a way. It's just sort of one spends money, the other one prints it to spend it. But it's the way the rules have been set up in central banking is that's sort of the game they have to play unless they come out and change the rules to allow a bit more explicit monetary printing.
Debt defaults.
Debt defaults, yeah. So the issue with debt defaults is you can't save everyone, and so it is good to see that that money wasn't thrown into trying to bail out Virgin. Having said that, though, there will be questions about the right things to do, and whether it's saying that part is saying if I step out of the way completely and allow that whole thing to allow Virgin to go under, and there's no replacement for it, then does that mean that we end up in a monopoly situation?
Yeah, competition's decreased.
So as long as that's not the case, and you can see that they'll sell their planes to somebody else, and so the shareholders all take a bath, and the bondholders all become shareholders, and you get some new bondholders, then those types of scenarios are a part of capitalism. That's sort of how you keep seeing it go on. So reacting quickly to those and not saving everything, but making sure that the credit pipelines stay open, and that if banks run into trouble and it's a significant issue, that they're stepping in quickly and making sure that banks keep lending and keep those sort of robust credit pipes sort of open to the rest of the economy, so that people who do have good business ideas and do have growth prospects aren't being starved of capital, so that you can prop up all the companies that probably should have gone broke. So yeah, the number of zombies that you're going to get is going to be pretty key.
Do you expect this to sort of pop out in the economy soon, Damien? Do you think we're staring down the barrel of debt defaults in the short to medium term?
Yeah, absolutely. I think there's the next 3 months is going to be pretty key to this. So and it's really within the small and medium business part that's probably going to be the real part to watch.
Yep.
Yeah. And so we just saw the other day, California extended its lockdown for another 3 months. So there's issues where, and if Australia sort of at the moment looks all right in terms of starting to come out of lockdown and some tentative signs that the virus has been brought under control, if things open up too quickly, or you start getting second wave effects, or there is a winter effect, then that's probably the last straw for a lot of businesses. So it needs to be managed carefully. And nobody knows where the right line is between how fast to reopen, and because if you open too, you reopen too quickly, you'll find that you get a second wave, and then you have to shut down again, and then a bunch of companies will just give up. So, and then that final one there is redistributing wealth. So in the in the aftermath of the financial crisis, we saw the rise of these 1% protests on Wall Street, where people were protesting about the amount of money that ended up being given to the rich and how the poor were suffering. Inequality's only ever got worse since that. You can come up with fancy ways to try and show that it hasn't, but the net effect is if you look at a mixture of both wealth and income, then there's certainly more inequality down than what there was before, and the fact that during the coronavirus, it is much harder to have there's not very many blue collar jobs that can be done from home, where there's a lot more white collar jobs that can. Is going to turn that into a worse effect. The net effect though is that the transfers in past debt crises, you've rarely ever seen a country that's been able to tax its way back to or actually even just make a significant dent in the debt by that redistributing wealth. I think over the longer term, putting in policies now that will redistribute wealth as it grows, or will try and grow the wealth in the lower income groups much faster than the higher income groups, is very beneficial to the longevity of the recovery.
Mm-hmm.
But redistribution on its own isn't really a solution to the problem. But if you turned around today and said, okay, we're going to have a wealth tax and we're going to tax anyone with a house greater than $2 million all of a sudden has to pay more, and anyone with an asset portfolio greater than $5 million has a wealth tax on it. That's not going to solve your problem in the short term.
Yep.
Over the longer term, it'll give you more resilience to society. But yeah, short term, there's no real benefits in that, and potentially counterproductive in some cases.
Okay. Sure.
I might jump. Given time, I might jump to sort of some of the policy responses,
okay.
the good versus bad. So and I'll just go through those stages as well of the bubble. So as you're going into a bubble, your good central banks are going to be considering about the growth in debt and looking at asset markets and trying to slow growth down, the growth of debt down, and using sort of macroprudential policies to restrain debt growth. And the bad policy is the ones where speculators and lenders are basically saying, well, property's been good for so long, therefore it must keep on being. Must keep being good, and that's where we've been stuck in. Is that the whole the central bank has it's made note of on a few occasions. I guess it's probably just disclaiming away some responsibility, but
bit of copy paste from the last meeting.
Yeah, but the net effect is they've been running low interest rates to try and spark a property boom to take over from the mining boom. As the mining boom came off in the 2012, their explicit policy was to get a property boom going, and so they got one going, and they got lots of debt, and then the guy who did that is no longer in charge, but you sort of pass it on to the next guy to sort out the next part. So certainly on the bubble stage, we didn't have the right policy. If you look at the top, central banks constricting the bubble either with a broad control of monetary policy or well-chosen macroprudential policies. This didn't happen. We argue, although the best thing to come out was that we had the Royal Commission that started to put a clamp down on lending for at least maybe a 12-month period where lending was quite constrained, and so that helped to without the Royal Commission, Australian houses probably would have had another 10 or 20%.
Yeah, that's right.
And so the depth of the fall was going to be even bigger. So there's a positive and a negative in terms of that. In terms of central banks continuing to tighten well after the bursting, that's not the case. We never really raised rates, or never raised rates, so they didn't have to fall.
Yep.
In terms of once you hit the depression side, the good central banks will be giving you all this liquidity. We'll be at a zero lower bound where we are. There'll be the aggressive targeted macroprudential policies we haven't really seen yet, but
What
we
would be
probably
an
will see.
example? What's an example of an aggressively targeted macroprudential policy, Damien?
Well, some of those is where you start to ease up on the lending constrictions that you might have
Okay.
put in at the top.
Yep.
And this is where we come back to saying, the problem in Australia is we started shooting all these macroprudential bullets, or we started easing up on them before, just to try and hold the housing boom at the levels it was.
So this is the sort of constraining investor lending over principal home lending and that sort of thing.
Yeah, absolutely. And then saying, okay, now investors can get back out and do it, or people can start taking on interest only, or what else is there? Some of the first home buyer grants, it probably starts to slip into the government side, but
Yep.
And these ones as well. These are the tools, all the tools you've seen sort of wheeled out over Australia over the last few years to try and keep it where it is, are the types that you should have waited until you had a housing crash, and then you wheeled them out or as you were having a housing crash, you wheeled them out to help stop how low it would go.
Mm-hmm.
And then you've got a few bad policies. The main bad policy one we really have to avoid is that austerity, or letting, if things do fall over, especially banks fall over, is that they do let them fail without keeping the actual underlying business going. And I guess the key message there is, you want the employees and you want the business itself, where the businesses make sense to keep going. The shareholders and the debt holders, they're the ones who need to take the pain. So if you start seeing the opposite happen, where or you start seeing shareholders and debt holders being bailed out too much, that's where you run into zombie companies.
Yep.
But where you start seeing, okay, say Virgin, too much debt, equities weren't making a good enough return, but they still have all these planes. If you can sell those planes to the next person for an extremely low price, maybe there's a business there as domestic travel restarts that might be worth it. But if you had have stepped in and tried to bail out the existing shareholders, that's where you run into the real problems in terms of creating the scenarios where you're just not going to get growth for years and years and years.
Mm-hmm.
So and then the final ones, the deleveraging parts. So as we start moving through this, it'd be good to see that there's plans for trying to bring the currency down. Is one of the big ones for Australia. You want to get nominal growth above nominal rates, and we've seen a little bit of that sort of started to be mentioned. You want to be sort of balancing the issues with defaults and austerity with the debt monetizations, and so it's a matter of trying to and making sure that both you haven't got your central bank and your government working at opposite ends, where for example, one of them's trying to pull back and stop spending on the money while the other one's trying to loosen up as much. And that was where we were for most of the second half of last year, was the central bank exhorting the Australian government to please get out and start spending some money.
Yep.
Because we've reduced rates as far as we possibly can, and the Australian government sort of basically saying no, that's fine, you keep lowering rates,
We want our surplus.
exactly, we want a surplus. And so that's where the danger is, the biggest danger I think for Australia is how much was it marketing spin, and how much does the Liberal Party really believe that surpluses are good things and deficits are bad things? Because if it comes down to that, and they start talking about we think we can get inflation, we think we can get unemployment down to 5% over the next 2 or 3 years, and then we're going to start let's put in all these processes so we can get back into a surplus again, and pulling back on government spending, then that's going to extend the crisis for a long time. So I might jump over that next one. So some of the bad ones, we leave those as red.
Yep. Okay. Literally.
Yeah, that's right. But the zombie banks and zombie companies are the danger. Zombie banks and the currency. I think for Australia, the idea of this inflationary depression is unlikely. There might be a stage where governments do print too much money, but we're a long way away from that. And so that's sort of the
It is a pretty commonly brought up sort of line though when everyone starts talking about things like quantitative easing and you sort of everyone's mind sort of reaches for Venezuela et al.
Yep.
And how is it different here? I guess is probably the key thing. Like it obviously the RBA's been conducting open market operations for quite some time now, supporting federal bonds. Is it the fact that it just doesn't leak down into the lower end of the economy and create inflation or hyperinflation?
Yeah. Well, the issue is why you've got inflation. So inflation sort of generally comes from two factors. One is you've got a shortage of supply. Mm-hmm. And so you need the inflation in order to send a price signal to bring on more supply and for people to share that scarce resource evenly. So let's say it's the 1970s was a lot of that was the energy side, was oil sort of pushing that through in terms of we saw some massive increases in oil, and there needed to be a price signal out there to bring on more oil and also for the oil that was out there, how do we share it? The other side then is a demand side. So and what tends to happen with the demand side is on the supply side at the moment, before I get through to that, we don't have a supply side problem. Mm-hmm. Most companies have got plenty of capacity. Oil is like overflowing everywhere. It's there's very few outside maybe protection equipment and masks and a few sort of select things. Toilet paper to a certain extent for a while there, but that's sort of come back on now. Webcam, that's right. Webcams as we've discovered internally. A few things like that where there is a genuine shortage, but for the most part, there's plenty of capacity out there, and companies want more demand. On the demand side, the issues usually arise from inequalities. So if you spread out money so that everyone gets a fair bit of money, then everyone goes out and spends. Mm-hmm. If you pile up most of the money with one or two, say if you've got 100 people and you give one or two people most of that money, then they're spending what they can and having a great time and saving the most of it because they just can't work out what else to spend it on. And everyone else is sort of stuck in this austerity stage where they just don't have enough money to go out and spend. Whereas if you spread it out more evenly, then you do tend to have that. And so the issue we've got now is demand because all these people have lost their jobs. All these people have seen people who have kept their jobs have seen friends and relatives and others sort of lose their jobs, and so they're a little bit more. They don't want to spend as much money. We can't. There's a lot of cases we can't spend as much money because you're limited as to what you can do.
Yep.
And that's quite possibly going to be going. Certainly at the in the richer cohort of people, a lot of the money that tends to get spent does tend to get spent on travel, and that's out of the case for probably the next 6 months at least.
Absolutely.
So so it's sort of like it's getting that demand side is really where you start to then get inflation, because if you've got too much demand and not enough goods, then you start seeing you need to bid those goods higher. But given we've got both sides of the equation, we've got too much supply and we don't have enough demand. It's very hard to see where inflation is going to come from. You can get, obviously if you print too much money, you can get inflation, but we're a long way from that still.
Yep.
That is very much the problem of at best 2021, more likely 2022 or beyond.
Yep. Okay. Sure thing. A couple left there. Helicopter drops and fiscal monetary tensions.
Yes, that's probably that's probably covered off on a lot of that. I guess it is noted that there's different ways governments tend to get through this. So if you look at how do you do these helicopter drops? So Japan in the 1930s, so coming out of the Great Depression, US and UK in the 2000s, and US during World War II. Was very much an increase in sort of debt-financed fiscal spending. So basically the government spends money and the central bank sort of passes it across. Sometimes you get it where the Treasury they're not on the hook for the debt, because basically the central bank just prints some money to cover the debt payments, and that's what happened to Germany in the 1930s. Or you can see the central bank lending to entities that's not the government, and they use it for stimulus projects. So, say China in 2008 sort of did a lot of lending. The central bank was lending a lot to the development banks, which then spent the money. And so it's sort of a bit of question about, some of it's just sleight of hand, but there's different ways you can get that out there. Other times, countries have just not even bothered issuing debt. They just basically print the money and give it to the government to spend. So, Imperial China would do that. The American Revolution, that was done. There's the US Civil War as well. Germany ended up there in the 1930s. The UK was there in World War One. So, there's plenty of cases where that's happened in the past, and under duress, I've no doubt that's where you can go in the future. And then the real helicopter money, though, tends to be printing money and directing straight to households, where central banks puts it through, and so there have been cases in the past where in the Great Depression, the central bank started paying veterans bonuses, literally paid just straight from the central bank to US veterans. And so there's certainly a potential if things get bad that they can move down that part. The other way, the historical way as well, was that you'd have a jubilee where you just have these big debt write-downs and then big amounts of money creation. And so, having said that, that seems less likely. I think politically that seems unlikely at the moment. It's certainly very much the way countries tended to get out of the financial crisis was sort of extending and pretending. Mm-hmm. And I think there's probably the argument that they'll go through that phase of central banks printing the money and giving it to governments to spend at least initially, unless we get stuck in that depression sort of side for quite a long time, which time maybe you'll start looking for alternative ways. So I'd like to jump to that final slide. Oh, sorry, actually the second one. So the second one is this, how long does it take? Sorry, the second last one, the normalization.
Yep.
So normalization is usually 5 or 10 years. So it seems, stock markets seem to think we've reached there in 5 or 6 weeks, but it's usually
good set of binoculars. Very good set of binoculars on the market, it feels like.
Yeah, exactly. And the other note as well is that usually equity premiums remain really high through that period. What I say by equity premiums is you don't get expensive markets because there's just no growth, and because you're not seeing that growth, and there's the reluctance for people to spend and lack of demand, is you usually get quite high equity premiums, which would mean much lower valuations, and that hasn't been the case so far. So that's quite possibly one we've got looked forward. So on that last slide, just to sort of give you an idea as well, the types of things we're really looking for from just the things to take out of it for investors is that sooner is definitely better, and central banks and governments have shown very much so far that they're very swiftly on the case. So that's a good sign.
Yep.
But it's not a sign. It's not a sign that everything's fixed. It's a sign that we won't go into a 10-year Great Depression.
Pain might not be so bad, so to speak. Yeah.
Exactly. We're less likely to go into a massive depression. It's very rarely do you ever get inflationary, especially in countries that can print their own cash, print their own money.
Yep.
And have debts denominated in their own currency. Mm-hmm. And then this other part is that I've said about the disappearance of credit and it needs to be replaced, is that we had, for the last 20 years, we've had debt growing faster than income. And so it needs to reset lower. And you need to see that's not going to be the case. And so you then need to see that governments are stepping in to support the growth that was really just funded by others sort of stepping in, by others being willing to gear up. So the way we've been discussing it, especially in terms of the whole inequality side, is the inequality changes and it means that most of the money ends up with one or two people in the economy. Those people then very generously lend to the rest of the people so that they can afford to keep buying houses and buying cars and all that sort of stuff. and then those people make even more money, and then they get to lend the money back to the broader public, and that's not the case. We don't think that's going to be the case anymore. We think we've reached the end of that line, and it seems to us quite likely that a debt crisis will result.
Yep. Okay. Fantastic. I was just about to finalise with that very question. So I think you beat me to it there, Damien. It's always good to finish an answer or to answer the question that we've kicked off with. And so, I guess on that note, well, thanks very much for your input there today, and for a terrific and quite long and very involved podcast on our debt deleveraging. Is this the big one? I hope everyone has enjoyed. We'll be live again 12:30 next Thursday, and we'll look forward to catching you there. Cheers. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.